One of the most important aspects you should understand about a reverse mortgage when you begin to consider one, or especially before entering into one, is how the interest works. You'd be surprised at how many people reach out to me who already have a reverse mortgage who have no clue about how their interest rate works or even what kind of interest rate they have. This is a major problem because if you don't know how the interest rate or the interest works with this loan, how are you supposed to make any sort of a well-informed decision on whether it's a good fit for you or not in the first place? And further, without this understanding, if you did decide to get a reverse mortgage, how would you expect to properly manage your loan over time? So in today's video, I'm going to be going over exactly how the interest rate on a reverse mortgage works and how that affects the interest that the loan incurs over time. And if you stick around until the end, I'm also going to be giving some very important pieces of advice on how to help save you interest in the long run if you wind up choosing to get a reverse mortgage. So listen up closely because there is a lot of valuable information coming your way. Hey guys, Taryn Proctor here with Retirement Home Equity Advisors, back with more reverse mortgage education. For those that don't know me, I am the founder of REA and am a reverse mortgage expert that has been solely specializing in this type of financing for the better part of the last decade. I create videos like this about once a week to help educate you about the ins and outs of reverse mortgages in hopes that it'll help you make the most well-informed decisions at the end of the day. So if you find the information we're about to go over helpful, don't be shy and hit the thumbs up button to let me know. As well, be sure to subscribe to my channel if you have not already. Subscribing is totally free, doesn't require you give any of your personal information, and just ensures that you have more immediate access to my videos when they come out. And if you head over to our channel after you watch this video, you'll also find many more videos like this one that go over a number of topics about reverse mortgages. So if your goal is to learn what you can about this loan, you'll definitely want to check out the channel and all the information you'll find over there. Now, back to reverse mortgage interest. And the foundation I want to lay out for you first is clarifying what the difference is between interest and an interest rate. So an interest rate is the cost of borrowing money expressed as a percentage. And then interest, or the interest a loan incurs, is the cost of borrowing money expressed as a dollar amount. With that said, it's important to initially break down how the interest rate works on a reverse mortgage to better understand how the loan incurs interest. When it comes to reverse mortgages, folks have the choice of a fixed interest rate and an adjustable interest rate. We will, of course, discuss both interest rate types, but the reality is that most reverse mortgages wind up being adjustable rate because of the additional benefits the adjustable rate offers with the line of credit. If you'd like to learn more about why that is, I'll put a link to a video I did on this topic below in the description of this video. I highly recommend checking that video out as well. I point that out though, because if you are just beginning your research into reverse mortgages, you'll want to make sure that you pay attention to how both of these interest rates work. So first, the fixed interest rate. This is pretty easy as the interest rate is simply a percent that is based on the market that can never adjust. Whatever that starting percent is, it will remain that same amount for the life of the loan, as the term fixed suggests. As for the adjustable interest rate, this is a bit more tricky. An adjustable interest rate on a reverse mortgage is actually made up of two pieces that are added together to make up the total interest rate. And what may be surprising for many people to learn is that only one of the two pieces of an adjustable interest rate can actually change over time. The whole thing isn't able to adjust. To clarify, the two pieces that make up an adjustable interest rate are called the margin and the index. Now, the margin is the part of the interest rate that is never able to adjust or change. This piece of the rate is locked in for the life of the loan. And the index is the part of the rate that can adjust and change. And currently, when it comes to the federally insured reverse mortgage, the most common index that is offered is able to adjust once a month with the market. This means that the adjustable part of the interest rate or the index will be locked in for 1 month at a time, then adjust the next month and lock in again for the rest of the month, then adjust again and lock in again for the rest of the month, so on and so forth. As an example, let's say the margin on the loan is 2% and the initial index is 3%. If you add those two pieces together, that equals your total interest rate. So that would be 5%. Now, the margin or the 2% part, that will always remain at 2%. The 3% index is what will be adjusting. So let's say after closing your loan, your index is able to make its first adjustment on May 1st. And on May 1st, that index is now at 3.2%, which means your index will now be at 3.2%, and would mean that for the month of May, your total interest rate would be the 2% margin plus the 3.2% index, which would equal 5.2% total. It'll remain that same amount until June 1st, when at that time, let's say the index on that day goes down to 2.8%. Now, for the rest of that month, your total interest rate will be 4.8% until July, when the index will adjust again. And just to clarify, even though the rate is able to change monthly, the total interest rate is still an annual rate. And that just means that on a monthly basis, you aren't being charged 5% interest each month. I think it's also important to note here that over the years, there have been different options offered when it comes to how often the index can adjust. It has always fluctuated between a monthly adjusting option and an annually adjusting option, meaning the index only adjusts once a year and then is locked in for the rest of the year. Although at the moment of this video, there really isn't a viable annually adjusting option available. I say it that way because the annually adjusting option is there, but the interest rates are way higher than the monthly adjusting option, which in my opinion makes them a non-viable option. But that may change over time. The important piece that you need to make sure you're aware of is at the time you are looking into the reverse mortgage, knowing and understanding exactly how often your interest rate will be adjusting. Additionally, to make sure we are all on the same page here, the index or the adjustable part of the interest rate can in fact move downward as well as upward. And it can do so at whatever pace the market is moving. And that's just to say that if the market index decreases by a whopping 3% in 1 month, your index will do so as well. Unfortunately, that works in the opposite direction too. Although, with that said, there is a cap on how much the adjustable interest rate can increase over time. This is an important safety feature in case interest rates continue to rise significantly. And the most common offered cap currently is at 5%. That means the total adjustable interest rate could never increase more than 5% on top of the initial interest rate. So let's go back to our example of the 2% margin and 3% initial index, giving us a 5% total initial interest rate. With the 5% cap, the interest rate in our example would never be able to go above 10% in the worst case scenario. That's because you add 5% to the initial interest rate of 5% to get to 10%. This feature of the loan has changed over time as well, and may do so again in the future. So it's always important to make sure what that cap is prior to moving forward, because there is a 10% cap offering currently, but at the moment, this option does not offer any sort of benefit to you. So there would be no reason to consider it at this time, in my opinion. But that may change in the future as well. So always good to know and understand these aspects of your loan when you're looking at a reverse mortgage as an option for yourself. All right, now that you have a good understanding of how these interest rates work, let's get into how these percentages affect your loan amount and how interest actually accrues on a reverse mortgage loan balance. And hang in there with me because this next part is more important than the first part. Also, quick tangent, if you've learned something valuable so far, don't forget to hit that like button and subscribe to the channel if you haven't already. Okay, so the first piece I want to talk about when it comes to reverse mortgage interest, and remember, the interest is the cost of borrowing expressed as a dollar amount. But first thing is the fact that there are many factors that can change how much interest the loan is incurring during any given month, even if the interest rate doesn't change. And let's break this down a bit more in detail. Now, reverse mortgages have a borrowed amount, also known as the loan balance, as well as an unborrowed amount. Unborrowed meaning you could have money left in your reverse mortgage loan that you have not withdrawn or used yet. The unused or unborrowed amount is generally held in what's called a line of credit. And if you haven't learned anything about the reverse mortgage line of credit yet, I highly recommend doing so, as this is one of the most advantageous features of the loan. I'll put a link to a video I did on this topic in the description of this video below. Take a look when you have a chance. Now, a very key feature of reverse mortgages to know is that you only get charged interest on the amount that is actually borrowed. Any unborrowed or unused amounts do not incur interest because you haven't used it yet. As an example, let's say you qualified for a total reverse mortgage loan amount of $250,000. And any mortgages you have on the property plus closing costs for the loan automatically get paid for initially out of that $250,000. So let's say closing costs and your mortgage payoff total $100,000, which means you automatically have a $100,000 loan balance or borrowed amount initially, and then you have $150,000 left over in your loan amount to then decide how you'd like to handle that money. So let's say you determine you don't need any additional money at the closing of your reverse mortgage. So you decide to leave the $150,000 in a line of credit, a line of credit that you can withdraw from at any time. You just don't need anything from it yet. In this scenario, initially, the $100,000 is the borrowed portion or the initial loan balance, and the $150,000 is the unborrowed or unused portion of the loan, meaning only the $100,000 will begin to incur interest. And only later down the road, when you withdraw an amount out of the line of credit, will that amount then get added to the loan balance or the amount borrowed. So let's say 5 months into your loan, you decide you need $5,000 out of the line of credit. When you withdraw that money, that $5,000 will get removed from the line of credit, decreasing it by that amount, and the loan balance or the amount borrowed will increase by that amount. And there will be a constant running calculation that will consistently be changing every month based on the amount borrowed and the changing interest rate if you choose the adjustable rate option. Lastly, we're going to run through one more very important piece to understand about reverse mortgage interest. And then we're going to put the pieces of our examples together to show you how the interest rate affects the interest in real time and really show you how this all works. So the last piece that is important to note is that reverse mortgages have what is called compounding interest. This is when essentially interest is charged upon interest. This is because of the fact that reverse mortgage loan balances are generally increasing over time. And if you have a loan balance that is increasing over time because of the interest the loan is incurring, and the interest is based on a percent of that loan balance at any given time, you wind up being charged interest upon interest. Additionally, reverse mortgage interest accrues monthly. So each month, as your balance rises, the dollar amount of interest can also rise because it's based on a percent of that loan balance. So let's take all of our examples we've mentioned so far and piece this all together one last time. Remember, we have a total reverse mortgage loan amount of $250,000 where only $100,000 is used initially. That means we have an initial loan balance of $100,000 and we still have an unused portion in a line of credit of $150,000 and an initial total interest rate of 5%. So if we begin with a $100,000 loan balance and an initial 5% annual interest rate, that means our loan would incur about $416.60 worth of interest month one. And now our initial loan balance has grown to $100,416.60. Then month two, the interest our loan has incurred will be calculated based on the new higher loan balance that includes the interest that was incurred month one. So month two, assuming our interest rate didn't change, our loan will have incurred a total of approximately $418.34 worth of interest, now making our loan balance at the end of month two $100,834.94. The dollar amount we incurred was a bit more than month one because our balance was a bit higher. Also, side note, the interest rate will of course change throughout the course of the loan if an adjustable interest rate gets chosen. So the calculation of the interest rate would of course change with that. But if the fixed rate is chosen, that monthly rate would stay the same. Now, we are assuming no interest rate change in this example, even if an adjustable rate is chosen, because this video is just simply giving you the basic understanding of how the loan incurs interest. Lastly, let's say in the beginning of month three, you decide you need to withdraw $5,000 out of the unused portion of the loan, because remember, you have $150,000 that is still unused. That $5,000 will be removed from the unused portion, leaving you with $145,000 there, and will then immediately get added to your month three loan balance of $100,834.94, making that total loan balance, or the borrowed portion, $105,834.94. So now month three, that interest calculation will be calculated using the increased balance of $105,834.94. Hopefully this is all making a bit more sense to you. Keep in mind you can always rewind this video, so it may take a few passes for it all to sink in. But ultimately, your annual interest rate at any given time will be broken down into a monthly interest rate, which will then get applied to whatever your loan balance is at any given time. But if you are not making payments towards the loan, which most folks don't, that loan balance will continue increasing every month based on the interest rate and the amount you have borrowed. Finally, this brings us to the advice that I give every single one of my clients and will give to you all as well. When entering into a reverse mortgage, you do not want to pull out money from the loan that you do not need or have use for. Because the second you withdraw money from the loan, it immediately gets added to the borrowed portion or the loan balance and begins to incur interest. I hear about way too many folks who don't fully understand this aspect of the loan, and it wound up costing them a lot more interest than was necessary. The longer you can keep your borrowed portion or your loan balance lower, the better. Even if a loan officer tells you you can get a better rate if you withdraw money you don't need, in many cases, it'll save you more interest in the long run to take the higher rate and leave the money you don't need in the unborrowed portion of the loan. Additionally, you can also choose to make payments towards your reverse mortgage. This will limit the compounding nature of the interest, or in other words, mitigate how much interest your loan incurs in the long run, because of the same concept I mentioned about keeping your borrowed portion or the loan balance of the loan lower for as long as possible. There are many additional benefits that come along with making payments towards the loan, and I'll put another link to a video I did on this topic as well down below in the description. So be sure to check that out when you have a chance. And that is it, folks. I know learning about all of these topics one video at a time can be pretty overwhelming. So if you are really considering a reverse mortgage as an option for yourself, or you know someone who is, please don't hesitate to reach out to me with any questions. Because these videos are made generally, there is a lot of information that needs to be included. Whereas a specific consultation will be much more pinpointed to your situation and many times is much less overwhelming. So if you'd ever like to chat, you can reach me at 888-982-0475. I know this was one of my longer videos, so I appreciate you hanging in there with me and hope you learned a lot today. And again, if you did, hit that like button and don't forget to subscribe to my channel. And with that, I will look forward to seeing you all next week. Take care.